You know that iconic image, right? The ringing of the opening bell at the New York Stock Exchange. That crazy, frantic start to the day. And then, at 4 p.m. sharp, the closing bell sounds. And that's it. The market goes to sleep. Or does it? Well, what if I told you that closing bell is really just the beginning of the story? Today, we're going beyond the bell.
What if I told you that for a whole lot of traders and investors, 4 p.m. is just an intermission? That the market is actually still buzzing, reacting, and moving long after the TV cameras have packed up and gone home. So let's pull back the curtain and take a look at the hidden world of 24-hour trading.
Okay, so before we dive into those hidden hours, let's set the stage with what we all think we know, the normal 9-to-5 market that makes all the headlines.
This is the window you see on the news. From 9:30 in the morning to 4 in the afternoon Eastern Time, the big exchanges like the NYSE and NASDAQ are in full swing. This is where the vast majority of trading happens. We're talking millions of people, which creates a really deep liquid market. But the thing is, this familiar window doesn't show you what happens next.
Here it is, the full picture. The trading day isn't just a work day, it's actually a full 24-hour cycle, at least on weekdays. It's broken up into these 4 different sessions. You've got the regular hours we all know, and then you have these extended sessions, after hours, overnight, and pre-market. This timeline right here, this is going to be our map for the journey. All right, the 4 p.m. bell rings. The floor traders are heading home. What happens now? Well, we enter the market's immediate second act, the after-hours session.
You can think of after-hours trading as the market's official overtime period. It runs from 4 p.m. all the way to 8 p.m. Eastern. And even though the main exchanges have packed it in for the day, a whole different kind of trading opens up, letting investors keep on buying and selling.
So why is this session so important? It all comes down to one word: news. You see, a lot of companies will deliberately wait to release major updates, like their quarterly earnings reports, right after the 4 p.m. close. They do this on purpose, to give everyone a chance to breathe and digest the information. And the after-hours session, that's the very first battlefield where investors react to that news. So how do you actually do it? It's pretty straightforward. You log into your brokerage, pick the stock you want, but, and this is the most important part, you absolutely must use something called a limit order. That just means you set a specific price you're willing to buy or sell at. You can't just hit buy at market price. And this is a huge safety net for you because, as we're about to see, prices can get pretty wild, and a limit order protects you from paying way more than you ever intended. Okay, 8 p.m. hits. The after-hours session is winding down. Does the market finally go to bed? Nope, not even close. Now we enter the quietest and maybe the most mysterious part of the cycle, the overnight session. This session runs from 8 p.m. to 4 a.m., and it's the final bridge that makes a true 24-hour market a reality on weekdays. It perfectly connects the end of after-hours trading with the beginning of the next day's pre-market. So you might be asking, why does this even exist? Well, it all boils down to global demand. As one source puts it, the popularity of the U.S. stock market worldwide is responsible for driving demand. I mean, think about it. An investor in Tokyo or London is wide awake in the middle of our night, and now technology allows them to get in on the action too. Now, hold on. This isn't available everywhere for everything. Only a handful of brokers actually offer this service, and it's typically restricted to the most popular, heavily traded stocks and ETFs. The whole thing is made possible by these really sophisticated electronic networks that match buyers and sellers directly, completely bypassing the main exchanges. As the overnight session ends at 4 in the morning, believe it or not, we're still not done. We just seamlessly roll into the final leg of our off-hours tour, the pre-market session. This is where the market really starts to warm up for the new day. Yeah, you can think of the pre-market as the morning stretch before the big race. It can start as early as 4 a.m., and it's the very first chance for U.S. traders to react to whatever happened overnight. Maybe some big economic news out of Europe or a corporate announcement that broke before dawn. But just because the window opens at 4 a.m., it doesn't mean the party starts right away. Honestly, for the first few hours, it can be a bit of a ghost town. The real action, the meaningful trading volume, that really starts to pick up around 8 a.m. as traders are getting to their desks, grabbing their coffee, and getting ready for the day ahead. So we've seen how you can trade pretty much around the clock. But now we have to ask the much bigger question. Should you? Because these extended sessions operate in a totally different environment, and that comes with some serious risks that you absolutely need to understand. Okay, The single most important thing to get your head around is this. You're not trading on the New York Stock Exchange anymore. You're in a completely different world, trading on these separate electronic networks. Think of it like this. You're leaving a massive, bustling public market and walking into a smaller, private club. And that changes everything. First up, let's talk about liquidity. During regular hours, the market is like a deep ocean. There are millions of buyers and sellers. It's easy to get your trade done. But in extended hours, it's more like a shallow pond. With way fewer people trading, it can be really hard to find someone to take the other side of your trade, especially if you're dealing with a large order.
And that low liquidity, that shallow pond, it leads directly to our next big risk, crazy volatility. With fewer orders out there, a single large trade can cause the price to swing dramatically. You could see a stock jump or fall several percent in a matter of seconds. That's something that's way, way rarer during the normal 9:30 to 4 o'clock session. And finally, there's the cost. There's this thing called the bid-ask spread. Basically, it's the tiny gap between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. During regular hours, that gap is super narrow. But in extended hours, that gap can get wide. And a wider gap is basically a hidden cost. It means you're almost always buying a little higher and selling a little lower than you would during the day.
Wow. Okay, we've journeyed through the entire 24-hour cycle, from the after-hours buzz to all the risks lurking in the shadows. So what does this all mean for you? Let's put all the pieces together and give you the final verdict.
It really just boils down to a fundamental trade-off. On the one hand, the pros are pretty powerful. You get the convenience of trading on your schedule and the agility to react to breaking news instantly. But then you look at the cons, and they are serious. Low liquidity, high volatility, and those wide spreads that act like a hidden fee. At the end of the day, it's opportunity versus risk.
So when you balance it all out, the big takeaway here is crystal clear. While the 24-hour market offers some incredible flexibility, it is a fundamentally different game. This isn't the major leagues you see from 9 to 5, it's a much riskier arena, and it demands caution and a really deep understanding of these new rules.
So the next time you hear that closing bell, remember, it's not really an ending. It's just an intermission. The lights go down on the main stage, for sure. But in the shadows, a different, riskier, and way more global performance is just getting started. The real question isn't whether the market is open, it's whether you're prepared for what happens when it is.